Yesterday, Republicans in Congress introduced their reconciliation bill that has a ton of higher education proposals. And like this commenter said, there are a lot of potential changes coming. So I spent the day yesterday and a good chunk of this morning going through all of it, running some numbers, and I'm going to break it down for you right here. This is what you need to know. This is going to be a very long video, but I also want to start this video with these are proposed changes. Nothing is official yet. This bill is just being reviewed in the House committee. The Senate also has to create a bill. They have to match these bills. It has to pass all the House and the Senate and then get signed by the president. And then most of these proposals won't go into effect until July 1st, 2026, moving forward. And a lot of these proposals, existing borrowers are grandfathered in based on your student loan origination date. So with that in mind, let's dive in. The first big change with these new bills is changes to student loan limits and student loan options. So the bill does propose eliminating the PLUS loan program. This includes eliminating Grad PLUS loans and Parent PLUS loans. However, it does increase the undergraduate loan limits and the graduate student loan limits to a formula. We love formulas. No, we don't, but it is funky. So the new formula is you can borrow annually up to the median cost of attendance for the program that you're in, minus any federal Pell Grant you receive. So that's how much you can borrow each year, which would significantly be higher for undergraduates. It might be lower for graduate students. So that's a wash, right? Parents can match their child's borrowing up to $50,000. So the Parent Plus loan program goes away, but parents can now have a matching loan, but their child has to have skin in the game as well. There are new aggregate limits as well. So the new aggregate limits are $50,000 max for an undergraduate and $150,000 max for a graduate student. And that's all you're going to be able to borrow with federal student loans. So there are a lot of different things. And yes, subsidized student loans go away. It's just student loans. That's what the proposal is on the borrowing side. Now, the big change on the repayment side is the elimination of the current income-driven repayment plan programs and replacing them with just two options. Going forward, after July 1st, 2026, so new loans that are originated after that going forward would only have options of the standard repayment plan, which the standard plan changes too, and the repayment assistance plan, or RAP. And that is the potential income-driven repayment plan version. Now, bear with me here because this is all wonky, but on the standard plan side, the standard plan amount will be based on how much student loan balance you have. And what I mean by that is if your loans are under $25,000, you will repay them over a period of 10 years. If it's 25 to 15 or 25 to 50,000, it's 15 years. If it's 50 to 100, it's 20 years. And if it's 100,000 or more, you have 25 years to repay them under the standard plan. So let's talk about the RAP now. The RAP is the income-based version of repayment plans, and it will set your monthly payment anywhere from $10 a month is the minimum. No matter how low income you are, you will always be making at least a $10 a month payment under the RAP plan, all the way up to 10% of your adjusted gross income. And it's tiered. So if you make 10 to 20,000, it's 1% of your AGI divided by 12. If you're over 100,000, it's 10% of your AGI divided by 12 to calculate your monthly payment. However, there is a benefit if you have children. You get $50 off your monthly payment for each dependent child under 17. IRS dependency rules. So if you have two children, it would lower your loan payment by $100 a month. Now, if it was to use that calculation and take you below zero, it would still require you to make that minimum $10 a month payment. So we break this all down on thecollegeinvestor.com. You can hit this article behind me. It gets very math driven to figure out what would my repayment plan be and how it would work. But let me break it down for you. So let's just say you make $25,000 a year with two kids. Well, your base AGI would be $500, but you divide that by 12, and then you get to subtract that $100 a month, and that would put you in the negative. So in that case, you'd have a $10 a month student loan payment. If you get up to $60,000 a year AGI with no kids, right? So we just take 60 times 0.5, percent. So that would be $250 a month. That would be your payment if you make $60,000 a year. It's not as complicated when you see the math, but it does get complicated overall. There's two interesting things, though, with the RAP program that are benefits. It's not all bad. I mean, there's some definitely people that will be negatively impacted. But the two benefits that I think are pretty cool with this is there's no negative amortization in this. So let's just say you only have a $10 a month payment. Just like what happened under the SAVE plan, your loan will never grow. If you don't make a full payment that pays off the principal and interest that you're supposed to, your loan will never grow. They also do a cool, what are they calling it here? Hold on one second. Calling it principal reduction help. And principal reduction help means that if your payment does not lower the balance on your student loan by at least $50 every payment, they will lower it so that you always are making at least $50 a month in progress to eliminate your student loan debt. Now, it's important to note that the RAP plan is a PSLF eligible plan, so it counts for public service loan forgiveness if it does go through. The standard plan that we talked about would not be a PSLF eligible plan. Finally, there are some other changes that could negatively impact people as well. One of them is they are removing economic hardship and unemployment deferments. The goal is, of course, you get into this RAP plan and you're still making $10 minimum payments if you have no income. So I don't know how I feel about that one yet. Public service loan forgiveness changes. They are proposing eliminating eligibility for medical and dental residents. Not doctors, once you're an actual doctor, but residents. So those that are in training in an internship or a residency program would not be an eligible job. It's not about the employer. It's an eligible job category for public service loan forgiveness. So they're taking that away from doctors in training. And in a good note, too, loan rehabilitation for those of you in default. They are now going to allow people to rehabilitate their student loans twice instead of one time. So you can get a second chance in that regard. So that's actually a win. There's a lot of other things in this bill, and we'll go into them over time. One of the big ones is Pell Grants. If you saw my article and video on Pellionaires, they are going to eliminate the loophole that allow millionaires to get Pell Grants, and they are going to create new workforce grants. So they're going to basically offer Pell Grants for vocational school, which that could be a win. And then finally, a little controversial one, depending on how you feel, but they want to give our student loan servicers more money. I know a lot of people are frustrated with how loan servicers have been handling things, but a big part of it is that they haven't gotten paid anything more since like 2018, and they're asked to do so much and change all their software systems all the time, and so they want to pay them more. Don't know how you feel about that. Drop it in the comments and let me know. So those are the big changes. Of course, again, these are proposed changes. They will not go into effect until they are voted on, passed. They may change, right? Like they're going to negotiate between the House and the Senate. They might modify these. They might cut it all out altogether and say, no, we're not going to do this right now. That happened before. A few times. We thought we might get the College Cost Reduction Act earlier. We thought we might get things change, right? And then, of course, it has to go to the president's desk, be signed into law. And even once it's signed into law, a lot of these provisions don't go into effect until 2026 at the earliest. So hit the link in bio, thecollegeinvestor.com. Of course, we have been doing the homework. We know what's going on. You can follow us, subscribe, and you'll always get up to date on this. And of course, leave a comment. I love to hear what you guys are thinking.